Hi everybody, my name is Belinda and today I'm going to talk you through some of the basics of dividend withholding tax as well as touch on foreign resident insurer tax. This is the last of 3 videos in this series. I've previously provided an overview of royalty withholding tax and interest withholding tax, and those videos are available on the RSM website. I'll begin today with dividend withholding tax. So dividend withholding tax applies to payments of dividends to non-residents. A payment of a fully franked dividend is exempt from withholding tax. However, unfranked dividends will give rise to an exposure. A dividend is any return on an equity interest and can include returns on non-share equity interests. So to the extent that an entity pays a return on some form of financing instrument to a non-resident, there is the potential for either dividend or interest withholding tax to apply. Where no double tax agreement is in place, the rate of withholding on an unfranked dividend is 30%. Where a double tax agreement is in place, the withholding rate on an unfranked dividend is capped, usually at a maximum of 15%, although there are instances in which this can be reduced or further reduced to nil. One example of that is in relation to non-portfolio investments. In that case, where the non-resident directly holds at least 10% of the Australian subsidiary, the withholding tax payable can be capped at 5%. Another concession, which is only available under a select number of Australia's double tax agreements, provides a full exemption from withholding tax on an unfranked dividend where a competent authority declaration is obtained. Generally, for such a declaration to be obtained, the recipient of the dividend must own at least 80% of the shares in the Australian resident. They need to be entitled to the benefits of the treaty and not to fall foul of any of those various limitation of benefits clauses. Examples of countries which have such a clause in their double tax agreement include the US, the UK and New Zealand. A declaration from the relevant competent authority must be obtained for that exemption to be applied. Where Australian entities are paying dividends which will constitute an unfranked amount, consideration should also be given to the Conduit foreign income rules. Dividends which are declared to be conduit foreign income by the paying entity are also exempt from withholding tax, and this is the case whether they're paid to a treaty country or not. Amounts which are potentially eligible to be declared conduit foreign income, where the income was received by the Australian entity from a foreign source. A typical example of that is dividends that the Australian entity receives from non-resident subsidiaries. Therefore, where taxpayers are receiving foreign income that is eligible to be conduit foreign income, thought should be given to maintaining account of those amounts, as it may allow unfranked dividends to be paid in the future, which are free of withholding tax. Where dividend withholding tax is payable and the payer fails to remit the amount to the ATO, interest and penalties will be applied. Penalties are doubled for taxpayers who are significant global entities. As with interest and royalties, all entities which pay dividends to a non-resident must lodge a non-resident annual withholding report with the ATO. And those reports cover the period 1 July to 30 June, regardless of whether the paying entity has a substituted accounting period. The report needs to be lodged by the 31st of October each year, and as I said, it includes not only dividend payments, but also interest and royalties. I was also going to talk briefly about the requirements for payments to non-resident insurers. So where an Australian entity makes a payment to a non-resident insurer in relation to Australian property or events in Australia, or the Australian entity acts as a broker or agent for a non-resident insurer, the Australian entity will generally need to pay foreign resident insurance tax. A tax return will also need to be lodged on the non-resident insurer's behalf, and the tax is calculated at 30% based on either 10% of total premiums or under an actual profit or loss method. Where the foreign resident insurer tax applies, Australian entities will need to retain the amount from the proceeds that are paid to the non-resident insurer and remit this to the ATO. Where an Australian resident entity makes a payment to a parent entity that includes an amount for insurance, it is possible for the foreign resident insurer tax provisions to apply. So examples of that include where the head entity takes a group policy and then uncharges the insurance premium to the Australian entity. Where this is the case, further consideration should be given to whether there is an obligation on the Australian entity. Premiums paid to an Australian principal office or branch of a foreign resident insurer are not covered by the foreign resident insurer tax. However, the Australian principal office or branch of the foreign resident insurer may be subject to Australian tax on its Australian sourced insurance business. So, as always, if you require any additional information in relation to dividend withholding tax, foreign resident insurer tax, or any other withholding taxes, please contact your RSM advisor. Yours in tax, Belinda.